Good evening, everyone. How is everyone doing today? So today I want us to do something simple, and that's why I had informed you earlier that I'm going to use less than 1 hour. Today's class will be purely theoretical. We're not going to do any calculation, okay? Unlike the previous class where we did some calculation on ratio analysis, this class is purely theoretical, and that is public sector accounting. But later on, when you'll be doing public sector accounting in your intermediate level, you're going to do some calculation. But for the purposes of this class, it is purely theoretical, and in most cases, you get questions that carries even more than 10 marks. Okay. So let us discuss public sector accounting so that in our next class, maybe tomorrow, we can do something on either manufacturing or incomplete records. So public sector accounting, as the name suggests, these are, for example, in Kenya, these are entities that benefit from the public fund. We have national government, we have county government, we have parastatals, we have political parties. And these entities that benefit from the public fund, they are required to utilize resources given to them efficiently. They are required by the provision of the public finance to utilize public resources efficiently or in a prudent manner. And as accountants in public sector, we are required to comply with the various provisions when we are maintaining proper books of account. So in public sector, we have what we call international public sector accounting standards. Okay, we have international public sector accounting standards. We call them IPSAS. Okay, so IPSAS, just like in these other entities, private sector, NGO, whereby when you are, as an accountant, when you are preparing financial statements, you prepare these financial statements in accordance to what we call international accounting standards and international financial reporting standards. Okay, that is in Kenya. In the public sector, we use International Public Sector Accounting Standard. International Public Sector Accounting Standard, these are regulations that have been formulated by different governments. They come together, governments from different countries, people with finance background from different countries, and other stakeholders. They come together through International Public Sector Standard Board. We have a board called IPSAB, International Public Sector Accounting Standard Board, that is responsible for formulating new accounting standards in the public sector. They are also responsible for amending. You know, sometimes there might be issues to do with interpretation of an accounting standard, issues to do with an accounting standard having a lot of loopholes for people to misappropriate funds. So when they want to amend or improve an accounting standard, that is done by this board called International Public Sector Accounting Standard Board. Okay, so we can conclude and say IPSAS, or these laws in the public sector, are normally formulated, amended by International Public Sector Accounting, International Public Sector Accounting Standard Board. Okay, now let us begin by asking ourselves, what is the purpose of public sector accounting? As an accountant, what is the purpose of public sector accounting? Why are we required to comply with the provision of IPSAS? Why are we required to to ensure that when you are preparing public sector financial statements, you comply with the provision of IPSAS. Number one, to enhance accountability, okay, for a country or for a nation. There is that expectation from the members of the public that because they are paying taxes, because you are borrowing money to, of course, finance your expenditure, you need to account every coin. Okay, we call this value for money. Okay, so for that accountability, value for money and accountability, those are 2 points. So for accountability, then for us to ensure this accountability, we need to ensure that every accountant in the public sector comply with the provision of International Public Sector Accounting Standard. Okay. Number two, as an accountant, when you are preparing statements, it could be budgets, it could be financial statements, we have what we call guidelines under these provisions that will help you to prepare budgets, to prepare financial statements. So they assist you as an accountant, okay, when you are maintaining proper books of account, when you are formulating or when you are coming up with budgets or you are coming up with public sector statements, okay. Then number three, of course, it enhances discipline, okay, in decision making, because every decision that you make, you must comply with the provision of International Public Sector Accounting Standards. You have to comply. And failure to comply with these provisions, of course, there are consequences. Okay. You may be required by the judiciary. Okay. Every year, any entity that benefits from the public fund, every fiscal year, any entity that benefits from the public fund, they are normally audited by the office of the Auditor General. Okay. So the Office of the Auditor General is responsible for auditing all these entities that benefits from the public fund. And upon auditing, they are required to give this report to the Parliament. Then Parliament is supposed to go through the report, and in case there is something missing, you can be recalled to answer or to clarify some important issues. And in case of misappropriation, then Parliament can again forward you to the responsible authority, the judiciary, for you to face the law. So you can see International Public Sector Accounting Standards enhance discipline. Okay, it helps governments or countries, county governments, parastatals to establish a public governance system, okay, that ensures that all accountants are in check when it comes to the affairs of that country, that entity, that parastatal, that county government. And then lastly, of course, all this is to ensure that there is value for money, okay, for the taxes paid by the citizens of that country. Now, remember, trust is very important even in public finance, trust and credibility. The reason why we are saying that these entities that get money from the public fund, they need to ensure that they maintain a good level of trust and credibility is because when the people or the citizens of a country fail to trust their institution, then that invites anarchy. Okay, and again, you can relate this to what is happening around even in our country. The reason why people are demonstrating is because they do not have trust and credibility on the government, on the governors, on members of parliament, because they cannot be able to see the value for their money in form of taxes paid to the state. Okay, so those are the purposes of public sector accounting. Purpose of public sector accounting. If you get that question on exam 8 marks, I hope you can be able to explain that. Okay, now let us discuss some of the important terms that you are going to come across in public sector. And this is very important because even in the past papers, you are going to come across questions whereby you are provided with terms and you are required to explain those terms. Okay, maybe you can be given 4 terms, you explain them, that is 8 marks. So I want you to make sure that in that paper, financial accounting paper, because 33% of that paper will be theory. 33% of that paper is theory, then the 67 is calculation. Make sure that the 3% is in your pocket. Make sure that 3% is in your pocket. Now, let us begin with the first term, what we call commitment accounting. This is a type of accounting in public sector. But what do we mean by commitment accounting? So this is where transactions in the public sector, okay, or any entity that benefit from the public fund will be recognized in their books of account once the entity commits to them. And I know this one is different from the private sector or from the provision of international financial reporting standards and the provision of international accounting standard, even the provision of generally accepted principles, GAPs. So commitment accounting is when you recognize a transaction once you commit to them. Okay. Remember, we have accrual concept in private sector. You have to recognize a transaction once you incur. Okay. But in commitment accounting, you recognize it once there is that commitment. So if the government makes commitment to do something, it is recognized. If that commitment is not there, then that transaction is not recognized in the books of account. As simple as that. So remember the word commitment. From the word commitment accounting, a transaction is recognized once you commit to them. Okay. And the purpose for commitment accounting, of course, is for budgetary control. Remember, in a fiscal year, when the government is preparing budgets, okay, not the government per se, but you know how it works. County governments prepare their budgets, we have parastatals, and then all this is taken to the National Treasury. Then the National Treasury is going to consolidate all this through the office of the what we call budget control. And then they will come up with one budget. This budget is the one that is read by the CS or finance. Okay. So this budget, it does not mean when the CS is reading the budget, does not mean that we already have that money. No, those are just estimates of revenue, estimates of expenditure, estimates of deficit, and how we are going to finance that budget. Okay, once that budget is read, then there is the finance bill that is supposed now to provide ways of raising that money. Okay, so that's why we are saying commitment accounting happens once that commitment has been made, then you recognize it, and it is normally used in budgeting. Then number 2, we have what we call fund accounting. Now, governments, both the national government, the county government, they normally have units, okay, accounts units. These account units that are normally partitioned into segments are what we call funds. For example, let me give you an example of the national government. If you read the constitution, the government is required to maintain what we call contingency fund. Contingency fund is a fund that is maintained separately for the purposes of emergencies, external shocks in an economy. We have what we call equalization fund that is normally maintained to cater for people in marginalized areas. Okay, we have the consolidated fund whereby all monies, okay, received by the government is maintained in that account. So, and for you to get money out of any of this fund, you need to have an authority from the members of parliament. We call this Appropriation Act. Appropriation Act. You also need to get permission from the controller of budget. But we are not interested in all those. What we are interested here under the terms used in public sector is that the accounts of government units that are partitioned into segments, these segments are what we are calling funds. Now, in terms of accounting, separate fund are required to have separate financial statements. So each fund will have its own financial statement. Are you together? So it's for, if it is for equalization fund, we have financial statements for that fund. For the other one, contingency fund, the same. If you come to the county level, we have also these funds. For example, in under county level, we have what we call the emergency fund. Again, this one is for emergencies. So each fund, you are supposed as an accountant to prepare separate financial statements. This is what we call fund accounting. Are you together? To get that in an exam, you explain it that way. Now, the other terms is what we call appropriation in aid. Appropriation in aid. So it's like I repeated this word. Also called AIA. Also called AIA. Now, let me use a very simple example here. And I'm going to use county government as my example. You know, county government is required to, or the county governments are usually financed by the government through what we call Commission of Revenue Allocation. So every fiscal year, Parliament will debate the amount of money that will be allocated to county governments. Of course, they work with the recommendation from the Commission of Revenue Allocation. And in Kenya, I can't remember the percentage. I think it's 30%. I can't remember. Okay. So this 30%, I'm just using it as an example, will be given to county governments, and then they are going to divide amongst the county governments this amount. And there's again a formula for dividing this amount. That's why you've been hearing debates on 1 man, 1 shillings, because others argue that funds should be distributed according to population. Others say funds should be distributed according to land mass, and so on and so on. You've heard of those terms: 1 man, 1 shillings, 1 man, 1 kilometer, and so on and so on. But now, apart from this amount that the county government is receiving from the national government, they are required to raise some revenue internally. Okay, they are required to raise some revenue internally from internal activities. For example, in county government, if you go to town today and you want to park your car there, you will be required to pay for parking. If you go to the market and you want to maybe sell goods there, you are going to be required to take a receipt, licensing. So these are form of revenues, okay, by the county government from internal activities. So appropriation in aid actually means this revenue or these amounts that have been generated by these government parastatals from their internal activities. Then, of course, during that fiscal year, they have already estimated through their budget the total expenditure of that year. So if your total expenditure for that year is 10 million, and you are estimating that you are going to collect 3 million from internal activities, then the national government is required to finance you the difference. 10 million minus what you are going to raise internally. Okay. So this is what we call appropriation in aid. Okay. The amount generated by governmental unit from its internal activities, and you are saying it is normally subtracted from the gross estimate. We are going to discuss the gross vote shortly. Are you together? So for universities, again, they are required to raise some money internally. You start some profit-making activities to boost your revenue, so that the deficit now will be financed by the government through capitation. Are you together? So that is appropriation in aid. Next is what we call paymaster general. Now, in public sector, Paymaster General is simply the cash account operated by this governmental unit. The way you debit, when you get money, we normally debit cash. When you use money or you make payment, you debit, you credit cash. So in the public sector, okay, these individual governmental units do not maintain cash account, or their cash account is what we are calling Paymaster General. So when you receive money from the national government, or when you receive money from the exchequer is an account in the consolidated fund. If you receive money from the exchequer, you debit that amount in the Paymaster General. When now you are spending or using this money, you credit the Paymaster General. So Paymaster General works just like a cash account. Are you together? And then now we have what we call GAV, General Account of Vote. I've mentioned to you that the CES in every fiscal year, the month of June or July, I can't remember the month of June or July in Kenya and in East Africa, the CES in charge of finance is required to read to the members of the public in parliament the various allocations or what we call appropriation to different governmental units, to universities, to judiciary, to parliament, to county government, and so on and so on. Okay? Then, after reading this budget, the members of the parliament will go through these estimates and approve. They can approve, they can reject it, they can propose amendments. Okay? But after parliament has approved this budget, okay, these amounts will be approved to each governmental unit. It could be parliament, it could be judiciary, okay, because now that budget is working. Are you together? So all these amounts approved, okay, to the governmental units is recorded in an account called General Account of Vote. Are you together? So it records funds allocated to various governmental units. So just remember that the General Account of Vote records funds allocated to the various governmental units after Parliament has approved. After Parliament have approved. So that is that. Then we have what we call Exchequer. I've told you Exchequer is an account in the consolidated fund. Okay? Are you together? Now, when the government receives money, all this money is recorded or is put in an account called consolidated fund. It records all monies received by the government. Okay, and sorry for that. And we have the exchequer. Exchequer is normally operated by the National Treasury. Consolidated fund is found in the central bank, but exchequer is normally governed and operated by the central bank. But what you need to know is that all these two accounts are almost the same. Sometimes we use the word consolidated fund, sometimes we use the word exchequer. But for consolidated fund, you need to know that all money received by the government is recorded in an account, is recorded in this account called exchequer. And within exchequer, we have what we call consolidated fund. Then the other term that I know we are all familiar with is the difference between recurrent expenditure and development or capital expenditure. So this budget, for example, in this budget that was read the other day by our CS, Professor Ndongo, recurrent expenditure was higher than development expenditure. So what do we mean by recurrent expenditure? This is expenditure on the day-to-day business of the government, such as paying bills. You can just say that word, paying bills. Bills includes salaries, okay, to government employees, electricity, water, telephone, name all types of bills that are incurred by the government, okay, bills that helps to maintain the operations of the governmental unit. Are you together? Breakfast, allowances, travel allowances, and so on and so on. So this is what we call recurrent expenditure. But we also have this other one called development expenditure or capital expenditure, and that should actually be, in economics we normally say that development expenditure should always be higher than recurrent expenditure, and that has been a problem with most developing countries. We find that for most developing countries, our recurrent expenditure or bills are higher than the money we put for development. So development or capital expenditure, this is now the expenditure concerning projects, long-term projects, projects that once you begin these projects, they are irreversible, projects that require huge amount of money. For example, in Kenya SGR, the dams that were never constructed, you know, once you put money in these projects and you don't complete them, you cannot recover that amount. These are irreversible projects, hospitals, stadiums, bridges, etc. Okay, and these projects are required or are supposed to open up an economy. Okay, are supposed to enhance entrepreneurial activities within an economy. They are supposed to help people or give investors some incentives to start businesses, employ people, but by doing that, enhancing economic development, not economic growth, economic development, because you will have touched the common man, meaning you will have enhanced the standard of living of people. Are you together? So we call this development expenditure. Okay. Now I told you, when you are, or the accounting standards in public sector that we normally employ, what we call international public sector accounting standards. We said these standards are normally formulated, implemented, okay, by a board called International Public Sector Accounting Standard Board, okay, IPSAB, International Public Sector Accounting Standard Board. So what is the role of IPSAB? Already I have mentioned to you that one is to develop the IPSAS, to develop high quality IPSAS. That is one. Number two, this board is also responsible, okay, when it comes to providing guidance. Now, for example, if there's a new international public sector accounting standard today in the public sector, okay, that is meant to enhance prudent use of resources, that is supposed to enhance discipline, the board is going to provide what we call transitional guideline. This transitional guideline is just a guide to the accountants in public sector on how they are required to use the new accounting standard. So that's all we are saying, it provides guidance. And guidance is normally done by that particular guideline called transition guideline. Apart from guideline, okay, they also provide resources to the public sector entities. Okay, what are these resources? Training, okay, interpretation of accounting standards, even technology. Okay, it could be at a fee, okay, but all these are required to enhance the adoption and use of international public sector accounting standard. Number three, we are saying they also issue and promote benchmark guidance, okay, to facilitate that exchange of information among accountants around the world. So accountants in public sector in Kenya, they can go to another country whereby this particular country has adopted fully international public sector accounting standards. So the accountants from Kenya can be able to learn from these other accountants in public sector in other countries. Remember, international public sector accounting standard is supposed to enhance uniformity among countries around the world. Okay, so it means that if you're an accountant in Kenya and the public sector, you can work as an accountant in the public sector in another country because all of you employ same standards. So due to that uniformity, there is that possibility of benchmarking against your neighboring country or another country elsewhere, okay, to facilitate exchange of information. Okay, so what are the benefits of adopting or using IPSAS? And I have mentioned some here. So for example, in Kenya, we have Uasin Gishu County Government, Trans Nzoia County Government. If all of them are using IPSAS, you can compare, okay? You can compare these two entities, these two county governments, because all of you are using same accounting standard. So if even performance, you can compare performance, you can compare adoption rate, you can compare so many things. So IPSAS enhances comparability, okay, among entities and governments. Okay, you can even compare Kenya and Uganda because all of them use IPSAS. Are you together? Number two, of course, the most obvious one and very important, it enhances reduced misuse of public funds. That means if you're an accountant in the public sector and you people are employing IPSAS, you cannot misuse public fund because you are going against the provision of International Public Sector Accounting Standard, and it's a law. And when you go against a law, you can be prosecuted. Okay, it enhances trust, credibility among the members of the public. Okay, and then the other one, IPSAS, you know, a country that utilizes its resources well means they are using IPSAS. So even to other countries, there is that credibility that when you give you money, either in form of grant or in form of debt, you can be able to repay. Okay, so it enhances that credibility, okay, of a country to its neighboring countries or international partners. Okay, adoption or use of IPSAS also improves consistency in the preparation of financial statement, because one principle under IPSAS is that you should prepare financial statement consistently. If you've used these accounting standards this fiscal year, you should use the same accounting standards in the next fiscal year. So there should be uniformity in the use of accounting standards. And those are not the only benefits. You can have as many as 10 benefits of IPSAS. And then lastly, the importance of accounting standards as a basis for preparing financial statement. Okay, so as a basis of preparing financial statement is because it enhances understandability of the elements of financial statement. You can be able to understand financial statement because even if you are an investor from another country, because all countries employ similar standards. It also provide guidance because all countries provide or use same standard. It means then you know that the provisions of these standards, and that can offer you guidance. The financial statements that are prepared using accounting standards, they enhance greater comparability. What we've just said, you can compare the performance of this entity with the performance of the other entity. And also entities that employ IPSAS, the elements of their financial statements will always be relevant to the users. Okay, because they have employed, they have used the provisions provided for under IPSAS. And with that, my friends, we are done. We are done with this short topic called Public Sector Accounting Standard. But I want us to go to the past paper and see whether we can get some theoretical questions. Let me start from the first one. So any question before we go to the past paper on public sector? Supposed to be easier. Any question or we are okay? Tuko sawa? So allow me to share the past paper. And we try to answer. Just try and answer some of the question here. So allow me to peruse through. Check any question that had public sector. Yes, this one. Question 5. This I can't remember the sitting. The sitting was, let me check the sitting. The sitting was August 2022. August 2022, question 5. Question 5C. We can also do even D. So for D, it is International Financial Reporting Standard, but when it comes to benefit, all of them are, you give the same answers. So for question 5C, explain the following terms used in public sector accounting. Appropriation in aid. What did we say about appropriation in aid? This is the amount generated internally by a governmental unit. Okay, so you generate this money from internal activities and from the estimate, okay, that you are going to spend in a particular fiscal year. This amount from your internal activities is normally subtracted for you to know the amount you expect to receive from the national government through what we call General Account of Vote, GAV. And then consolidated fund, this is a fund that is maintained by the government whereby all monies, okay, is received and recorded in this account. You can go ahead and say, for you to withdraw or to get money out of the consolidated fund, you need to have what we call Act of Parliament. You must have permission from the members of Parliament. Number 2, authority from the controller of budget. Yeah. And then number D, describe 4 benefits of adopting International Financial Reporting Standards. Did we do accounting theory as a topic?
No.
Yes, we are going to do that topic, accounting theory, whereby we are going to discuss materiality concept, accrual, duality, consistency, prudence, adoption of IAS and IFRS. Again, that one is a topic that's purely theoretical. That will take us 30 minutes. Okay. So under that topic, we are going to discuss the 4 benefits of adopting IAS stroke IFRS. So remember, this is different from IPSAS, but for importance or benefits, you just give the same answer. For example, one benefit to organization for adopting IFRS is to enhance comparability. You can compare 2 firms because all of them are using similar international accounting reporting standard. Okay. Another benefit is that it enhances consistency when preparing financial statements. So that is a benefit to firms or companies. So under IFRS, you don't mention public, don't mention the word public sector. Okay. So another importance of IFRS is that it enhances credibility of firms. Remember, for firms to borrow money from a financial institution, they must provide their financial statements. Okay, they must provide financial statements. If you've not followed the provision of IAS and IFRS, you are not going to get the money. So again, but if you have adopted fully the provision of IAS and IFRS, then it becomes very easy for you. So it enhances credibility of a firm, of the financial statements prepared by that firm. Okay, and so on and so on. But we are going to do that topic, but answers are the same. Let us see whether we can get another question on public sector in theory. So this is what I was talking about. You can see question 5A. This one is that topic on accounting theory, materiality matching, but we are going to do that. So let us discuss this. Explain the following funds in the context of public sector. We have what we call revolving fund. This one it was not there in our notes. What's the revolving fund? Now you've heard that the amount of money that is normally allocated through GAV to the governmental units, to the county government, they are required to use that money. But what about if they don't spend all that amount? That amount will be taken back. Okay, are you together? It will taken back to the national government. Okay, so this particular fund, revolving fund, this is where money is recycled back to that fund after it has been used. So you are given money through GAV, you are required to use it. Once you use it, they recycle it. But if in a situation whereby you're not supposed to use excess, you're not supposed to surpass, but if in a situation whereby you don't use all money, there's a provision in the constitution whereby you are supposed to get this back to I can't remember the unit that you're supposed to get it back. But the word revolving fund means this is a fund that is maintained separately, whereby after you use a certain amount of resources allocated to you there, then it is recycled back to that fund. Are you together? Then the word fiduciary. We are all familiar with the word fiduciary. So remember, even the government is required to maintain a separate fund, okay, on behalf of other governmental units, on behalf of other entities. So this fund, separate fund that is maintained and managed by the government on behalf of other parties is what we call fiduciary funds. Are you together? Are you together? For example, pension is a good example because the government is required to manage this pension on behalf of the civil servants. So it's a good example of fiduciary fund. Then analyze 4 objectives of financial statements. So under international accounting standards, we normally have 4 objectives of financial statement. There are only 4, and we are going to discuss that under accounting theory. 1 is understandability. 2 is relevance. 3 is comparability. I've said comparability, understandability, relevance, and the other one is, why am I forgetting the 4th one? The other one is, who can remember the other one? Comparability, relevance, understandability, and reliability. Yeah. So the financial statements you prepare, they must be reliable to the users. The financial statements you prepare, they must be understood by the user. The financial information contained in the financial statements should be able to help users compare the performance of that company with the performance of another company. The financial statements, the financial information in the financial statements of any entity should be relevant to the users, such that it informs them, it helps them to make informed judgment. Are you together? So with that, I think we are done. Tomorrow we meet for incomplete records at 5. Tomorrow we are going to do sole proprietorship or incomplete records. Financial statements, we are going to prepare financial statements for incomplete records.